this point in time, this happens to be my favorite panel, all due respect to everybody else, including mine that I'm moderating tomorrow afternoon, 2 o'clock downstairs in the breakout session. This happens to be my favorite panel of the entire conference. You'll understand why as you hear these guys go through, and we call it their discussion. So at this point in time, I'd like to welcome Teague Hunter. Yes, there is a correlation there to the panel, to the moderate panel. Woo. You're over there. Go that way. No, you next one. Yeah, I'm sorry.
You gotta go down over one. Okay. Right here.
We'll get seated eventually. This happens to be my favorite panel of the session, too. A little biased. Thank you guys for coming. Big thanks. I want to say 30th anniversary. That's incredible. So big thanks to Bob Hunter and Lee Hunter family, Nancy Petenbrake. I do think it matters, and candidly, big thanks to you guys. These conferences don't happen without attendees. Hopefully it's worthwhile. You keep coming back. I can remember when Bob was doing this 30 years ago. I was probably, gosh, you do the math.
Thank you.
I won't say, 14, and we're in the pool in Ormond Beach on the family vacation, and Bob says, I'm thinking about doing this conference. And Lee, who I think was right at the end, said, that's a terrible idea. And me, with a youthful enthusiasm, as these guys know, was like, do it, let's do it, this will be great. And I don't know, 50 people showed up down at the Sheraton first time, but 30 years later, here we are. So this is great. Thank you guys for coming, I do appreciate it. I think these guys are some of good personal friends with some of the brightest minds in our industry, with some of the deepest pockets, doing some of the most business. So I love talking to them. I think you guys will enjoy it as well. I want to know what they're thinking, what they're seeing in the industry, how they're spending their money, how they're raising their money, because I think that all sort of affects all of us and what we do. It trickles down to the rest of us. So without further ado, I'll do a quick introduction. Jim Merkel, CEO of Rockridge Capital in Columbus, Ohio. Thank you for being here. Tyler Morse, MCR, and now Morse Development, don't forget that, in New York. Shah, Noble Investment here in Atlanta, Georgia. And Suril Shah, Starwood Capital. Is it still global head, or I don't know what it is these days, but I keep giving you bigger titles. So I want to find out from you, all of you guys, and we can just talk, and this will flow how you know, but I want to find out what you're doing, what kind of deals you're looking at, how's this year compared to last year, and I want to know how about fundraising's going, and then how we're putting that capital out. Sound good?
Cool.
So I'm going to start here. Jim, start with you. Tell me, compare last year to this year, what you see going this year. Talk to me about
I'll try and hit all those. We just raised a new fund last year, roughly the same size, about 420 million. And the last 2 years, so 15, 16, we did about 12 deals, and last year we did 5 deals last year, but we delivered $600 million of renovation work last year.
Wow.
So we were pretty busy, and closed the new fund in the tail end of last year, and looking like we always do to find the right projects to put in the fund. And we'll have about 40 hotels in each of our funds.
Excellent. Finding the hotels is the key. Tyler.
So we are completing a fundraise right now, a little over $300 million. And I think last year we did, in the trailing 12 months, we've done 14 different investments in different hotels. And we expect that to be slightly higher, probably over the next 12 months. We think there's enough inventory out there. I would say it's always hard to find deals, but it's becoming a little harder right now because the refinancing market is so white hot that a lot of sellers are refining instead of selling.
Yeah.
So that's the biggest challenge that I think we see right now. But that means we're also getting cheap debt on our acquisitions. So it's kind of a win-lose situation.
Mitt?
So our funds are 2-year funds, so we're kind of always fundraising. Our value-add funds, where we do development and redevelopment, are always around $250 million. So we're putting out $200 to $300 million a year of assets. And development and redevelopment, we did something a little unique in just kind of the nature of the select service business and the thesis. I think we talk about this almost every year, and I've been coming to this conference 25 years, so it's really been kind of the thesis over that 25 years that's borne out. We raised a Core Plus fund in the lodging business, and I think for all of us that, if we think about the theme of Core Plus and lodging, you never thought that those were going to be used together, but it's really about the fact that if you can buy between a 7 and 8 cap and you can finance at a 4 at 1-to-1 leverage, those returns look really good across the duration. So we set out to say, let's go raise $200 million and that money, get it over 2 years, and we were oversubscribed, and now at $250 million of that with the same kind of LPs, state pension plans, endowments, and the like. So I think it was an interesting outcome, just kind of given the world that we're in terms of where capital is flowing and the thesis around this business. So that said, now that we have all this capital, what to do with it? Last year we were net sellers by a significant margin, and you're always hopeful. I think we're all in this business, naturally and been for a long time. So you have to be hopeful that there are going to be those opportunities that come available, but there really is a lack of product. And I think, probably for all of us sitting here thinking about that, to say, while we'd all like to be net acquirers, maybe this is a pretty good time to continue to be net sellers. We also put 5 new hotels in the ground last year. That's getting harder and harder based on a number of different factors. So, but I think that we still feel like this business has 2 to 3% RevPAR growth in the select service space. We're concerned about competitive wage inflation. So what does that do in terms of returns? But if you can still buy between a 7 and 8, or build to an 8 or 9, then I think that continues to be a strategy well employed.
I love it. You covered a bunch. Suril.
So at Starwood Capital, we just finished our fundraise for our newest fund. It's our 11th vintage fund. It's $7.5 billion of equity capital. It's a global real estate fund, and so it's a lot of capital to deploy, and I think our strategy is what our strategy has been, which is looking for opportunistic returns and looking for distress of where we can find it. We own everything from In-Town Suites, which is a economy extended stay platform, all the way to we developed the Baccarat Hotel in New York City, which is doing $1,000 night ADRs. And so we look kind of up and down the chain scale. Obviously, select service has been a significant focus for us and continues to be. I think one thing that Mitt said, which is very interesting, and it's a trend in this industry that I think a lot of people in this room have known for a long time, but I think maybe the greater real estate industry is catching up, which is select service is a real institutional investment class. I can remember 7 or 8 years ago, the Blackstones and even the Starwoods of the world. I think we made our first select service acquisition in the U.S. in 2011, and people were like, well, why are you doing that? And I think now Mitt's raising a core plus fund, which is going to be select service real estate. And I think a lot of investors are coming down to the conclusion that we've known for a long time, which is quality is not necessarily RevPAR. Quality is consistency and underwritability of cash flows. And I think select service has proven that out for a long time. And I think, one thing that in our investment committee that we've talked about with some of the guys who have looked at the business for 30 years is, you're seeing 7 cap rates right now for select service hotels. And you can remember not too long ago, there was 10s and 11s, maybe 10 years ago. And do you think that will come back? And I just don't think it will. I think there's enough capital now that understands the market. I think people are a lot more educated. I think kind of the gig's up in the sense that the people who were acquiring these hotels at 10s and made significant wealth, I think people have caught up to that. I think that's actually very good for our industry because it shows, and for select service hotels because it shows a significant amount of capital coming into it.
I remember specifically, I've been in the industry too long now, but the AmeriSuites. Remember all the AmeriSuites, right? And they got converted. And you could buy any one of the ones. They were asset light. You could buy any one you wanted in the country for an 11 cap. Your pick.
Yeah, that's right. It's amazing.
Mitt, pick up on him. He talked about getting out of the sort of full service space. You've been full circle. You owned all the W's here in Atlanta, as an example. You've owned lots of full service stuff. What's your opinion on full versus limited today?
Well, yeah, I think it's readily acknowledged by even the leading brands that suburban full service has a structural problem. And the select service that are in those markets are most often of better quality, and they're certainly run a lot more efficiently in terms of full-time employees and just spaces that you've got to cover. So that's not new. And I think if you can get into some urban markets that the labor works, that that's still a business that is worthwhile, and some unique markets, like Charleston that you're in, and the like. For us, while again 25 years of history, we've seen cycles come and go, and we've had full service assets across those cycles. Since 2008, we really just said exclusively we're going to focus on the select service because it's much more predictable. And at the end, for the way that we think about the business is that it's just about cash flows. Yep. And if you can predict better your operating model, and that is not going to grow to a certain level, you can take hits on the RevPAR standpoint, and as we've all seen across time. So a 20% hit to RevPAR. So if you even track the Great Recession, normally if you look at kind of all the 10-year history, RevPAR in the upscale lodging segment has trended well above the overall lodging assets. But if you just say that it's 2% RevPAR growth, right? Just for the upscale, and you track the Great Recession, you bought everything that you possibly could in 2007, and the exact impact of the upscale lodging segment, and you held that for 10 years, you still make a net 12 IRR. And at a 60% leverage, so at 5.5% cost of capital. So that math is readily available. It's not proprietary. It is what it is. So when you think about that, that investment strategy for us, it's just simple. And the other part is because it's simple, it's something that we feel like we can just dedicate all of our efforts to that strategy, develop, redevelop, and acquire assets on the core plus side that we'll hold for 10 years.
I think the other part of this equation that you got to talk about is replacement cost. When I first started investing in this space about 13, 14 years ago, people were talking about $100,000 a key for select service hotels. And they said, oh, $100,000 a key, that's a big number. I used to work for Suril's boss, and we went and looked at a hotel in downtown San Francisco, a terrific location, and he passed on it at $100,000 a key. Because he said, I got nosebleeds.
I'm gonna text him right now and tell him you said that.
And then by 2007, it was $150,000 a key was the new norm that, that's getting a little pricey, that's getting a little up there. Now I feel like it's $200,000 a key. I just built a Residence Inn down in South Florida. Prototype building, not a stellar piece of land or anything like that. It was $185,000 a key, fully loaded.
Sounds pretty good, actually.
That's the new norm, and it's going to be a terrific investment.
And what's the RevPAR going to be?
The RevPAR will be $125.
Okay, so that's great. And that's because $125 RevPAR is probably a $200,000 room hotel. I mean, room today, right?
For sure.
$150 RevPAR is probably $275, right? And so what we're seeing is, we used to, 25 years ago, you could build a Hampton Inn for $40,000 a room, and you have a $40 RevPAR, first year.
Yeah, right.
It's just a different business.
Well, and where it gets interesting is you mentioned suburban full service. Now you can buy a lot of suburban full service hotels at $25,000 a key, $50,000 a key, right? They're giving them away. And the bathrooms are 5 feet by 7 feet, and can it be turned around? It's a pretty interesting question. Some yes, and some no. And I think some people are going to make some money on that, and some aren't.
Jim, you guys are building a lot. What's your?
Well, I was just going to amplify on what these guys were saying about investors. They want predictability. They don't care whether it's full service or select service.
They used to, though, right? I feel like they used to.
I don't think they do today, and I think Mitt, you've done both, and it doesn't mean there's not good opportunities in full service and not great opportunities in select service. On the full service side, where we've done a lot of business and done well with is taking that old product that you can buy at discounts and fixing it to be competitive with a new room product. And
If you ever get a chance and go to Louisville, you have to see an asset a deal that we did together, which is a Marriott that we acquired from you guys, and you guys did a terrific job with that asset. I mean, it was a perfect, that's kind of not suburban. It was suburban full service that really exemplifies what you said. I think you did a fantastic job with that hotel.
Right, and what we're trying to do is leverage our strengths and our capital base and a little bit of creativity and confidence from the brands to do stuff like that. And I wanted to add also about replacement costs. I spent so much time thinking about replacement costs when I started in this business, and I think far less about replacement cost at this point. It's really a function of the cash flow and the cash flow potential of that asset. And I would tell you, we miss so many opportunities thinking about
price
replacement cost. And you look at the hotel business over the long term. It's a growth business. The RevPAR goes up, revenues go up over time. You hit cycles, but if you're well capitalized, you hit your 12, and that's in a lot of very well known investors are at the top of the investor list over history with a 12 over the long term.
I love it. Let's talk about cycles. Is there a cycle coming? Are we concerned about anything, Suril?
Oh, you didn't say the word inning. I thought you were going to say, what inning are we in? Listen, I think in this business, and especially in the fund model that we're in, you can only look out as far as you can look out, right? And that might be a really cheap answer, but I think you can look out 24 months. And I think you have a pretty good understanding of what's going to happen in the lodging industry in the next 24 months. And I think for me to sit here and pontificate and tell you what I think is going to happen after that, I think I would have been wrong in 2014 and wrong in 2015. I would have been wrong 16, 17, and that tells me I would be right today. So I think the fundamentals are good. I think 2018, after the January and the February that we had, is shaping up to actually be a pretty good year, despite what you're hearing from some of the REITs. I think at least our portfolio, we're feeling actually quite good about it. At least, especially our select service portfolio, which is kind of across the U.S. It's almost 400 hotels. We feel pretty good that we're going to beat budget, and budget was a healthy growth rate over 2017. 2017 was soft for us, but I think 18 and 19 look pretty good. I think after that, I think I'd just be making it up.
Let me ask a different way. You have $7.5 billion to spend. You nervous about that?
Certainly you're nervous about it because I think anyone knows we're 96 months into the cycle now. I think or 96 months of positive RevPAR growth. I think we're certainly nervous about it, but you got to find differentiated ways to put it out. And I think one thing that we're doing, you look at what's happened with the brands, and not even the big brands. I mean even the small brands. There's so many new brands coming out, and I think you have to find a brand. We actually developed one kind of in-house that we think we can deploy a lot of capital behind. And it's our one hotel brand that we have a few of them. We have a few more coming. And I think when you have a brand that you can develop and exert a little bit of control over, I think it helps you underwrite cost structures. It helps you underwrite. And when you know how they're managing the other assets, I think we'll probably spend a couple $1 billion on developing one hotels over the next 5 years.
Let me go down the brand path. We're going to take a tangent. So the brand he's talking about is the one hotel brand. They have two assets, one in South Beach, one in Manhattan.
We have one in Manhattan, one in Brooklyn, one in South Beach.
Correct.
That are open right now. And then we just bought an asset, which is now soft branded, the Jeremy Hotel in West Hollywood, that will become a one by the end of the year.
So I know you guys also invested $250 million in Yotel, which is the opposite end of the spectrum, right? One is at the very top. Yotel is sort of the hostel, whatever.
Yep.
My question is, do you guys really believe in brands? Is that the future, or is just a Barry loves doing brands?
I think you have to look for some kind of differentiating factor, and I actually think a lot of new brands. I mean, I'm certainly talking my book right now, but I think a lot of brands kind of feel the same. I think you look at a lot of these new brands, and you don't really know what's different about this 4+ star brand than the next one. And I think if you look at one, I think it's a very differentiated brand. I think it actually has a DNA that is resonating with a wide variety of people. And I think if you look at Yotel is different as well. It's not, you had trouble even mentioning how to describe the brand. It's different, and it's, I think that's what we look for, to invest behind differentiated brands.
I wasn't going to go here, but you can decline Mitt to answer if you want. But if you guys don't know, Mitt is the chairman of the board of La Quinta as well, who just spun the brand off to Wyndham. Jeff Bellotti, congratulations. Any comments on brand?
Well, I mean, it's in the proxy, so this is, it's pretty public. But it's hard for brands that don't have scale to really be able to effectively create loyalty and therefore drive customers to proprietary channels. It's hard enough for Marriott and Hilton that have all the scale in the world, and Intercontinental that's kind of building scale. But so that's hard. The technology piece is hard, et cetera. So a natural outcome for these brands are to figure out how do they, for their franchisees, be able to kind of lower the costs of distribution, enhance loyalty, and the like. So, M&A in our business on the C Corp side, will continue to happen. I think the last panel talked a lot about that, and you see brands that, Regent, that kind of people forgot about, like, okay, well that's, Woodspring, that was kind of an incubator brand. So, I think what was interesting is just kind of the amount of interest that was in the company, substantial amount of interest in terms of that. And the outcome of that is, that transaction will close here in a couple of months, and then it'll essentially create a mid-scale REIT, which has never really existed. Now, maybe it existed in the mid-'90s because everything was mid-scale in terms of, Winston and RFS and the like. But in today's era, that's never existed, which is actually pretty neat, because for the very first time, you could never take a company like this public. It had to have been spun and been public anyway, which is what CorePoint Lodging will be, the REIT. They'll, start with 300 mid-scale and upper mid-scale hotels, all under $100 RevPAR. And so the business model is to grow a company and a platform owning this vast majority of hotels that exist out there at less than $100 RevPAR. And that story is exactly what we've been talking about. It's a cash flow story.
I think it's a brilliant strategy.
Right. Well, and I'll, it's brilliant when, it proves out that thesis. Because going out, the question is that, will it really, create that kind of cash flow? And so for everybody that, owns, assets that are $85, $90 RevPAR, and, Summit's not buying that, and Apple's not buying that, and, a whole bunch of folks aren't really buying that. There's now a business that can be this aggregator of all those assets. And, oh, by the way, all those people, all of us that own $85, $90 RevPAR, there's real cash flow that comes out of that. That business. So I think that's going to be something that's very, very interesting, but the theme is exactly the same. It's a cash flows theme. So when Summit went public, they had, this portfolio of assets throwing off a lot of cash flow, but the market gave them no credit relative to, just that cash flow that's been created until they actually saw the movie play out for a couple of years. And now they're trading at the highest, EBITDA multiple of any of the lodging REITs, higher than Host and higher than, than Park and the like, at a fraction of the size. So I think, again, Suril, you made this point about the institutional marketplace paying attention to this. That's a great proxy right there. The public marketplace is valuing select service REITs at a higher multiple than all the other lodging REITs. So I think there's an interesting part to that.
And I think Summit got there by giving a consistent cash flow, consistent dividend over and meeting that number, and just consistently saying this is what we're going to do, and then hitting those numbers.
But their dividend's not even that high.
No,
right? but it's the consistency
and the leverage and the leverage levels. I think Dan's done a great job.
Right. Can I make one comment just about cycle? So it's interesting because everybody wants, you said like
you
if I
do the
were
innings,
inning, right?
You gonna do the innings?
I don't even think about that because I can't even program out. We just all know, all of us being in this business for a long time, that that this is an industry that has black swan events take place that affect us. It's never supply led. That exacerbates the problem. So kind of in our mind, you say, look, Dallas is different than DC, and Tampa's different than Atlanta, and LA is different than Phoenix. So, that's kind of how we all kind of think about the micro versus just the overall macro. But if it's a 2 to 3%, I think the biggest things that we're probably all struggling with is it's not just competitive wage inflation, it is finding people in general. So the vast amount of our hotels that have had to go to contract labor, it's pretty significant, and that's real margin erosion that takes place in even a select service box. So that's kind of one. And yes, interest rate risk are there, but if you prudently leverage, I mean, there's just there's a certain amount of that, but that's there. But the property tax issue is massive. Like, how many deals do you look at and say, okay, this makes sense, we can buy at this cap rate. Oh, but by the way, when we transact, the property tax number, is going to turn this from a 7.5 cap to a 6.5 cap.
Oh, yeah.
Right? And it's just, and I think those are things that are structurally more of an issue and a focus for us right now than, simply like, gosh, we don't want to catch a falling knife and the like, because, this is a long business and you'll get through that with the model. But those are structural issues that I think are important to pay attention to.
Comments? I do think it's fun to watch. When final thing I'll say on La Quinta, Mitt took the company, spun it, sold the brand off to Wyndham for a heck of a multiple, and then now we have this real estate REIT sitting here that is an $85 RevPAR publicly traded REIT that owns those assets, when most of the publicly traded REITs own $120, $150 RevPAR. So I'm fascinated to see what happens, how the Wall Street reacts, how the street reacts to this publicly traded real estate REIT playing in that $85 space.
I think I'll just put a prognostication out. I think the multiple's low, and then they'll hit their dividend, and they'll hit their numbers, and then it'll be high. And then it'll just kind of move into the lodging REIT sector.
Yeah, but look at Extended Stay America. It hasn't worked for them. They trade at a terrible level. I think Wall Street has a institutional bias toward high RevPAR, and I hope it works out for you.
The shareholders.
For the
shareholders.
I'll be fine. You don't have to say it perfectly. I'll be all right. It's a part-time gig. I'm cool. But I appreciate it.
He's got a day job.
You're looking out for the right people. But I think the banks and Wall Street have always had this institutional bias, and I'm not sure I see that going away anytime soon. It's gotten a lot better. Select service is a more institutional asset class than it used to be. But Host is the 800-pound gorilla in this space, and it's the one-eyed man in the land of the blind. And I think they're going to continue in a down cycle. They're going to go back to trading at a premium. It's a tough equation to beat to get through that institutional mindset when there isn't a res system powering those assets. The strongest res system in the United States is Marriott. It drives about 65% from central res. Hilton's about 55%. When I worked at Starwood, it was 22%. Hyatt, I think, is 24%. The central res delivery is what you're paying for as a hotel owner, and I think that's going to hurt La Quinta, at the end of the day, it being a part of the Wyndham family. But
what I love about this conversation for the panel and for the audience is that Suril's doing one, which is at the highest end of the market and doing Yotel. We got La Quinta, and we're talking about creating value there and talking about brands. You can create value where the customer is has demand. There's demand for your product. And you can do it at mid-scale, you can do it at luxury, you can do it. And what we've been trying to do and continue to do is that not be biased either way. It's like, where is the opportunity? Where is the market for that product? And how do we create value for our investors there? And I think that you can do it in a lot of different ways. And I think this conversation is exactly representative of that.
I totally agree. We're doing a bunch right now with ESA and their asset light program, and so we have excellent visibility into that extended stay model. And it is, Suril can echo this, he owns In-Town Suites. It is an unbelievable cash flow business. So take all your ego of your one off the table, and In-Town Suites makes a ton of money.
Yeah, I think we bought the company and added on, I think our total, we'll do quite well in the transaction, and I agree that there's an institutional mindset against that for that like look like it's a higher quality rep or a higher quality asset. I just think that the gap is shrinking.
I agree.
Massively.
Massively.
And I think Summit is a perfect example of that when you look at the multiple.
So let's move off of that. Let's move off of that. Give me, Tyler, tell me, let's go back to global. Tell me what you see in the globe happening today. What gets you excited? What makes you nervous?
Just to follow on to that comment, I got to comment on this. Look at the multiple. So Marriott, Hilton, for the most part, Wyndham, Choice are generally intellectual property companies these days. So I thought Muhtar speaking today was very appropriate.
Yes.
That's just an intellectual property company. Look at the multiple that Marriott trades at versus the multiple that Wyndham trades at. Marriott trades at a big premium because it's a higher end brand. So I think that perception is still out there. There's a lot of noise in that equation as well.
So stay there. Don't answer my question. Different question. Talk about the TWA hotel. If you guys don't know, Tyler's doing arguably one of the most iconic hotels in the world. Just ask him. It is. It's at JFK Airport's TWA hotel, but there's
He's a broker, by the way. He'd like to sell your hotels if you have.
Correct. So give us an update on that, and specifically about the branding and your involvement with Coke and all the everything you've learned and the unions.
Sure. So we're turning an iconic Aero Saarinen design building at JFK Airport into a hotel, the TWA Hotel. It's going to be 515 keys, 50,000 square feet of event space, a 200,000 square foot lobby. It's a little over a $300 million project, and it's going to be quite neat. We're about a year away from opening. We're spending $20 million a month on construction. So it's about $1 million every business day, 650 union guys on the site every day. We have a lot of brand partnerships, and on that one we are going independent. We are not going to flag the hotel because we have latent demand that is endemic to the airport. So we've made the judgment that we don't need to fly a flag there. So some very smart people have said that's a very crazy decision. So time will tell. We'll see what happens in about a year.
I got my TWA pin. I'm putting it on.
Oh, thank you.
Solidarity.
It's an interesting project. You know, we have 7 retailers, 8 restaurants, 6 bars. It's not like a traditional hotel. And, you know, we are trying to take a page out of Yotel's book, and we're going to sell the rooms twice a day. So we have a target occupancy of 200%. Right? The Yotel at Heathrow Airport runs 250% occupancy.
Yep.
Right? Because they run the day stays. So the trickiest part there is getting the computer system. The entire hotel industry has a PMS system, a property management system that is geared around night audit at 2 a.m. And it can't really process the day stays. So the industry is not evolving really as it should be from a technological standpoint. So we're trying to solve those technology problems, and we think we have a solution for that. But it creates some interesting issues when you want to sell a room to somebody at 7 a.m. who gets off a red eye and just wants to stay until noon and have a shower, get a workout in, have a little nap, and then go into the city when the traffic is less.
I love it. Let's go, Jim. I'll go ask you. Tell me what you're seeing, what your crystal ball shows. Tell me what's getting you excited. Tell me what's making you nervous.
Yeah. Well, I think what I hear a lot is that it's hard to do deals today, and I just think it's always hard to do deals. I mean, in 2010, 11, it was hard to do deals for different reasons, and it's just always hard to do deals. And there's a lot of fear of peak, and smart people don't want to do a bunch of business at the top, and I think you never do enough at the bottom, and you always do too much at the top of the market. And if you're a long-term investor that capitalize your projects correctly and you weather those storms, you create value over time. And so we're just trying to, pick our spots. We're going to do, 10 to 15 deals tops a year, and we just try to do the ones that work for our investors, that what we sold them and provide the returns that they're expecting, and then we get to do it again. And so we're always looking for value add. We do a lot of redevelopment work and some ground up, and definitely getting more challenging when you're talking about replacement costs. I mean, we're building select service properties for what your replacement cost is. And again, markets move and locations move, and there's not product there, and you can create value there as well. So we're just trying to be patient and pick our spots, but not really worry too much about where the market is overall. Just do good deals that work fundamentally, one by one.
Tyler, any macro comments? Where are the black swans out there?
So I was thrilled at the Alice conference this year that it seemed to me that a lot of the Wall Street and the prognosticators had acknowledged or acquiesced that 2015 and 2016 was a little mini recession. The game had started over again, and now we're in the second inning, so we can dispense with this conversation of innings. I think that since 2010, demand growth has been, frankly, fairly anemic, but it has been consistently anemic, which I think is terrific. It's taken 8 years for the Fed to raise rates to back to normal levels, and I think that that's going to give a lot of runway in the economy. They're going to raise rates 3 times again this year. So the number one question I get is, okay, so if they keep raising rates, isn't that, what's that going to do to cap rates? And I always look at the example of when we were investing in 2006 and 2007, the risk-free rate on a 10-year treasury was 5%. You could make 5% on your money without getting out of your bunny slippers. You never had to leave home. You didn't actually have to do anything. But people were buying hotels at a 6.5 and a 7 cap. People were buying hotels for 150 basis point spread. And the reason is that there's people with capital that need to put it to work in the hotel business. And the spreads are going to narrow, but it's not like cap rates ballooned in 2017 to 10 caps because the risk-free rate went up to 5.
Well, if you look at what's happening in the debt market, even though rates are increasing and have been increasing, spreads are tightening. Right. Cost of borrowing is the same. I think cap rates are not exactly the same, but I think that there's the same stories happening there too. I mean, rates have increased, and I think the select service, if you take hotel cap rates, I don't think they've moved yet. We're looking at 100 basis points over the past, 12 months?
12 months, yeah.
Well, 100 basis points over the past 12 months, and it doesn't seem like cap rates have yet been affected.
I'd like to comment that Lee said at his opening talk that cap rates are 9.2%. I don't agree with that.
No,
I wish we were all buying.
Well, Mitt said in the opening he's buying 7 and 8s, right? Between 7 and 8. You guys all agree that's where you're buying?
Yeah.
And I can tell you from our perspective, because of the lack of, as Jim said, the lack of product on the market and all the capital that you guys have and others to put out, and everybody's been making lots of money over the last couple of years, that our cap rates are compressing.
For sure.
If you want to win that deal, you're paying a little bit more today.
I think you got to talk net cap rates. What are you looking for? Are you looking for 7, 8 net? What's your net cap rate? Because depends what you got to put into the asset.
The funniest thing about that
CapEx.
is we only talk about net cap rates now because we've all spent so much money renovating our assets,
That's
right.
and we don't get. Is Arnie here yet, or is that just that's right?
Arnie's not here yet.
You don't get anything for it. You don't get anything for it. You put all this money in, you got to go from the green package to the blue package, and maybe you don't get. That's probably
opportunities and possibilities.
It's not. It's just we all look at net cap rates now. We all look at because we don't look at the PIP, and we don't sit here and say, okay, this $2 million PIP or $3 million PIP is going to increase my NOI by a significant number. I mean, we're putting millions of dollars into these assets, and then afterwards we say, I'm making the same amount of money I was making the year before. It doesn't feel like a fair deal. Sorry.
I'm gonna let
I'm on my
Suril stand
soapbox.
up.
That was good.
We're all.
Yeah, there you go. You got
Do not print that, please. Oh my God, I'm going to scream that.
I love it. Mitt, comments?
I'm I'm excited about the opportunity, going on the brands for a second, for brands to actually use their weight, specifically Marriott, to do things that are transformational for our industry, specifically around revenues. And so, I think nice first step in terms of, the commission, the new commission plans that the major brands have cut with the third-party intermediaries. We all are concerned about Google. We're all concerned about, what does the Airbnb phenomenon truly mean? I think the brand CEOs would say, we believe scale is important because loyalty is the most important thing, and owning that customer is the most important thing. So when you think about, a situation whereby we've, now introduced prepay options to, get the customer to start doing what they're already doing with the airlines, even though, we're completely different given the fragmented nature, having the ability, the opportunity today, because of Marriott's size and being a first mover, Hilton would follow, I would follow, all these brands would follow, to literally go to a scenario whereby when that customer books a room and they book it through any channel, they're paying for it at the get-go. If they book through the proprietary channel, then maybe they get the ability to use that credit for a future booking, within the system, right? But then you have this immediate ability to have this effect whereby that customer, who still today doesn't really know where am I going to get the best deal and the like, but the new OTA deals, now provides a lot more clarity and transparency around that, start utilizing that proprietary channel at each of these brands as their first option, because they know that if they don't use that, then they're not going to be able to get that credit to use anywhere. That's transformational. So we can all talk about amenities and this and that, et cetera, but to really change the landscape of our business, the opportunity is there. I think the intent is there. The risk and concern is, on the flip side, we don't move fast enough, because we need to move at a pace that really takes advantage of this demand environment that we're really in. And so in the conversations that we have, I know that all of us have, and I'd encourage all of us to have, encourage our brand partners to really think in that way, to do things that set a new level platform for us relative to the revenue piece. And then we can start thinking about things like robotics relative to our guest rooms, and more data analytics in terms of being able to really be even more efficient than we really are. Because at the end, we've got a business model today that, while still lucrative and profitable, like we're talking about 7 and 8 caps. We're not talking about multifamily at 4 or industrial at 5, right? I mean, and we know that it'll ebb and flow, but we've got a structural cost model that we got to continue to deal with. But I think we're at a moment in time, because we're at the first place that first point in time where we have some brands that have some real scale that can actually create this momentum to change the structural model.
Well, I think to take off on that, I always use the example, and I agree with everything that Mitch has said. The airline industry in the U.S. Does roughly $200 billion in annual sales. $65 billion of that is not the airfare. It's the baggage fee, it's the peanuts fee, it's the cancellation fee, it's the credit card program that they're always continuously announcing on the plane while we're flying on the plane. We have captured the customers. They are captive to us, but for some reason the hotel industry writ large thinks it's anathema to charge people along the way for additional services. And whether it's cancellation fees, parking fees, resort fees, facility fees, I think just competing head-to-head on a number that comes up on the OTAs and Expedia and Booking is a race to the bottom. We need to differentiate our products. And if you at the luxury end of the market, it really is a differentiated product. Your folio bill is a lot more than just your room rate. And I think that should migrate its way down to the select service part of the world in different fee structures. But you say what you want about Spirit Airways, it's a very profitable business model. You may not like flying it, you may not like that they charge you $5 to print a boarding pass or whatever, but it works because you can fly from New York to Florida for $39, and it's the total democratization of travel, and that's a terrific thing. And their planes are absolutely the ultra low-cost carriers. So I think the hotel industry at a broad level needs to not just compete itself into the ground, and we have a distributed ownership structure, which makes it harder to execute the game theory that we all think we should.
So I'm gonna wrap this up, but I want to do one fun question. I'm gonna pick on Mitt for a second, and I did it with Chris Nicetta. I interviewed him one time and asked him what was harder, running Hilton hotels or raising 6 daughters. So, Mitt, I'm picking on you, and this is a serious question. We're all business leaders or running companies, and we all know the joys and sorrows of that, and motivating people and giving them direction. You're the obvious brilliant leader of Noble Investment. My question is, where will Noble Investment be in 10 years? And before you answer, since I just put you on the spot, I'll stall. I know that you're a minority owner of the Atlanta Hawks. If you guys don't know, Mitt's a minority owner of the Atlanta Hawks. And you have developed wonderful relationships with your majority partners, who are obviously very successful in their own right. So what have you learned from those guys that's going to help you lead Noble in the next decade?
So I'll answer the second question first. I'm very focused kind of in, always thinking about peer groups and learning and never being the smartest person in the room, and just kind of always getting feedback from people that I feel have had success across a broad range of industries. So there's a small handful of us in the group, all very, very successful people, including, Sarah Blakely here in Atlanta, Founders Banks, and, we all come from different kind of backgrounds. And I found that actually just the ability to learn and different ideas and different thoughts, and actually the courage for the Core Plus platform came from, one of the partners, Tony Ressler, runs Ares, and just like the magnitude, and showed me all the data of just like how this entire planet is looking for 8%, kind of coupon returns, and where do you find it? Endowments and pensions and the like. So that's been very rewarding, and I think just kind of my thirst for always searching out people that have different ideas and thoughts and the like. That's been one of the greatest outcomes of that. That part of it. So the other part in terms of Noble in 10 years, I also think about long-term strategic planning all the time. I think part of one of the great thrills of being chairman of La Quinta is that I've had the ability to tap into a vast amount of resources around succession planning for that business, and now for CorePoint, the REIT, that'll be there as well. And so I think about player development on the sports side and player development at Noble being a primary responsibility for any leader. And so for that standpoint, I'd like to continue to have the ability for our team to get better and better and better, both through internally things that we do, as well as broaden their reach, get out of their comfort zone. I think one of the unique things is that the company we founded 25 years ago, and over that time, we've put together this entire team, and we've been together now, on average of almost 17 years. And so that's incredible loyalty, but also, you tend to kind of think of each other as like, wow, we know what we're doing, and not get out of that realm. And so over the next 10 years, I think that we're an outcome of our ability to continue to never be the smartest person in the room individually, and go find the smartest room, and collectively, I think that benefits all of us, and hopefully, the outcome of the business. That's great.
Go Hawks.
Go Hawks.
Thank you guys. Please help me welcome thanking them for being here today.